Goldman Sachs facing major implosion in 2023 subprime crisis. Goldman Sachs is one of the largest investment banks in the entire world and is a worldwide finance industry leader. However, despite their power and influence, they are entering a major crisis. This is due to their subprime lending practices, as banks like Goldman Sachs have been lending money to subprime borrowers. In finance, subprime lending is the provision of loans to people in the United States who may have difficulty maintaining the repayment schedule. Historically, subprime borrowers were defined as having FICO scores below 600, although this threshold has varied over time. Hi, you've reached Finance Sense, the place where we discuss all the most recent trends in the financial markets and the economy. But before we get started, make sure to give this video a thumbs up, hit the bell notification button, and subscribe to our channel so that you can stay up to date with our new videos. Having said that, let's get started. Goldman Sachs is presently in the midst of a subprime loan crisis that is estimated to be worth billions of dollars and is predicted to completely devastate our economy, similar to the one that occurred over a decade ago. But it's not what you're thinking. This time, it was not the doing of the mortgage market. Instead, it was something that was happening more frequently every day. However, it's not only Goldman Sachs that will suffer. Wells Fargo, JP Morgan Chase, Bank of America, and virtually every other bank you can think of are all suffering from the same difficulties, sitting atop an inferno of too much debt owed by individuals who cannot pay it back. We are now beginning to understand what is really going on, and the evidence that suggests that everything is collapsing is also becoming more apparent. But the scope of the entire situation is far more than you could ever fathom. Prominent Wall Street banks began announcing their quarterly earning reports, which provided information on how they had performed throughout 2022 and during the fourth quarter. For the most part, it was terrible. Morgan Stanley witnessed a 40% decline in revenue, while Goldman Sachs saw a 66% drop in fourth quarter earnings from a year earlier. The CEOs and founders of new firms are opting to stay on the safe side and not take any significant risks while these banks negotiate deals, go public with their businesses, or arrange mergers and acquisitions. This is because the impending recession has been increasingly clear over the past several months. But for these banks, this is not the major issue. Deal-making is still a tremendously successful aspect of all of these firms, generating billions of dollars annually. Yet, these banks are already suffering billion-dollar losses due to the impending subprime industry. Only a few years ago, Goldman Sachs decided to expand its consumer lending business, loaning money to average individuals for a variety of purposes. As a result, they diversified into providing loans for cars, homes, and consumer credit cards, among other things, with the utmost confidence that these services would give enormous revenue down the road. Goldman Sachs is aware of the state of the economy and has long recognized that markets go through cycles. There are times when interest rates are low, followed by cycles when they are high, and a few years back, the scale was beginning to tip in the favor of the latter. How did Goldman respond to that? They chose to invest in a financial industry sector that typically does incredibly well when interest rates rise. They entered the consumer lending market. If mortgage rates average 3% as they did a few years ago, and you can lend out $1 billion worth of mortgages, you might earn $30 million annually. Nevertheless, if interest rates were to double and remain at 6%, your income would increase to $60 million. The same is true for credit cards, student loans, and car loans. This was the field in which Goldman wanted to grow. Historically, this has meant large profits, satisfied investors, and fat paychecks for the bankers involved. However, things did not go as planned, and Goldman Sachs has already lost $3.6 billion on their expansion, leading them to decide to cut it down altogether. Now, Goldman asserted that this was due to their rapid expansion and that the debt they had already issued seemed to be in good standing. However, they can only actually lose all of this money in one manner, and subprime loans are to blame. Goldman failed to account that as long as the loans are repaid in full, the profit margins increase dramatically when interest rates climb. But what happens if a pandemic occurs and our government's response causes an inflation of over 10%? The cost of people's debt increases as your incomes go down every month and interest rates rise. Consumers can no longer pay off their loans, and Goldman Sachs had no idea how terrible this crisis would grow. Therefore, their pivot is bound to fail. They failed to anticipate that the situation would become as dire as in 2008 and that they would be responsible for covering the cost of the defaulted debt. Nonetheless, Goldman is the only major bank required to disclose its inadequacies in its new business pivot to its shareholders. But Goldman is not the only major bank affected by this. We do, however, know that other institutions are experiencing identical problems because they are all engaging in the same activity. They are loading up on cash to try to withstand the impending catastrophe. Throughout the last 3 months of 2022, the 4 largest banks stashed away $2.8 billion. This action was taken for the sole reason of protecting the businesses from the inevitable mass loan defaults. Now, let us remember who these banks are. They are the same businesses and workers that, in 2008, nearly brought down the world economy for the simple reason that they hated to lose money. They did it as they were aware that they were too large to fail, and as a result, they saw no reason not to give out every last dollar they possessed, while also taking the profits immediately, regardless of what may occur. But they are now deciding to save money for a rainy day and rejecting calls for higher profits at a time when their earnings are already declining and their shareholders are already displeased. While trying to figure out what these firms will do next, we should look at what they are doing rather than what they are expressing. Their actions clearly warn that the subprime crisis is poised to spiral out of control. So how is this possible? How is a second subprime lending crisis possible? And what is preventing it from becoming a reality at this point? All of this is, after all, uncharted territory. Similar to the subprime lending crisis of 2008, this one is centered on credit cards and car loans rather than mortgages. Meanwhile, credit cards are the root of the problem because ever since the pandemic ended, inflation has devastated us all, driving up our cost of living at a rate that hasn't been witnessed in more than 40 years. Although the standard of living of the general public has declined over the past 2 years, the economy has shown little signs of slowing, and consumer spending has remained strong. Yes, it's true that we can't just conjure up money out of thin air, but luckily, banks and governments are already doing that for us. This is where the initial half of the problem stems from. Everyone was taken aback by the fact that personal savings rates grew during the pandemic. Nevertheless, this development is not surprising at all when seen in retrospect. We continued to get paid through remote jobs or government stimulus checks, but were prohibited from going outside to spend our money. As a result, most individuals just saved. The funds we accumulated are still there, but they have been diminishing over the last 2 years as individuals felt the pinch of inflation on their wallets and chose to do 2 things rather than cut back on their spending. They either wasted their funds or used their credit cards. Sadly, the personal savings rate, now hovering around 3%, indicates that we have gone past normal. Since 2008, it has been at an all-time low. In the past 100 years, the only time things have been significantly worse than they are right now was at the depths of the global financial crisis in 2008. Even back then, it was just around 2.8%, but it is now about 3%. Individuals are only spending to sustain economic growth. Yet, it's living on borrowed time because people's savings will eventually be depleted and consumption will plummet. During the height of the pandemic, total U.S. credit card debt was estimated to be about $500 billion. But credit card debt has been alarmingly climbing ever since inflation picked up in the second half of 2021, after which it climbed up another $50 billion without increasing at all during the lockdowns. As a result, credit card debt has been rising even when people are becoming poorer. However, this can only occur if regulations on acquiring new credit card debt are generally easing. The reason why it is referred to as another subprime catastrophe is that the growth in debt has been caused by subprime borrowers, not the rich. Furthermore, this will result in massive issues in the future. But before we get into that, we need to discuss car loans, the second major bubble. Now that prices have skyrocketed, everyone is aware that a storm has been developing in the car industry for some time. Yet, most people are unaware that the real issue here is not the worth of the cars themselves, but rather the value of the debt secured by the vehicles and that its owners can't afford it. In essence, what transpired was that individuals were accustomed to incredibly low interest rates on debt, which led them to take out excessive loans on vehicles they could not really afford. This was an excellent financial choice for a while, since you could drive a car you bought in 2020 for a year and sell it for a 10% profit, but a year later, depending on how the market ultimately moved. But the market is no longer there, making these loans an issue. Nowadays, car prices are falling dramatically, with some vehicles losing value by as much as 30% annually. Moreover, the same borrowers of these substantial loans are currently in debt. Meanwhile, the banks fully know that they owe more on these cars than they are worth. Those who owed this debt must pay the money or file for bankruptcy. There is no simple option. Nevertheless, things start to become intriguing. Banks have begun to waive open auto stipulations. Dealers, customers, and financiers are all unable to sell or finance each other's vehicles. As a result, the financial system or the banks simply allow consumers to purchase another car despite the fact that they already have an auto loan open, are unable to pay it off, and lack sufficient assets to support the loan should the client default. In contrast to subprime loans, these new vehicle loans are certain to default, which is why this is the second phase of the crisis, as every bank in the US is involved in this disaster. There is no getting around the fact that when these defaults and repossessions begin, the car market will be oversaturated with inventory, driving down car prices even lower. That's why financial institutions have been amassing $3 billion in cash in recent months to weather the inevitable storm of defaulting customers on credit card and car loan payments. And that's all because of how simple it has been to secure a loan. As a result, everyone has leveraged themselves to the maximum. Thank you for watching this far. Please leave a like, subscribe to help us expand our future audience, and comment down your thoughts in the comments section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and look out for the next video.